It's not about how long you've worked at your job. It's not about those other elements that you may have in your life. It's about the property. It's about its location, its condition. It's about how much capital is in that IRA. And it's really about the cash flow of the property ultimately. Is this a make sense deal or not? Higher LT, and not a lot of lenders to choose from, by the way. And I do have a list. So if you want my list of non-recourse lenders, it just gets shorter every year. But email me, and I will certainly send you that list. And my email, I have all my materials back there, but it's khall@udirectira.com. Okay. So larger down payment required. You're not going to personally guarantee the loan to your IRA. And if you get somebody to guarantee it, they just can't be one of these people. Okay. One of the things that happens when your IRA borrows money is, this is another total surprise. It seems completely, you wouldn't ever guess it. Your IRA can be taxed. How many people know that your IRA can be taxed? Yeah. Yeah, life experience, right? Well, there are two ways. And one of them is called UDFI, when your IRA borrows money. So it's not the end of the world. Sometimes you can talk to your tax preparer, because sometimes there are ways to take deductions on this so that you can minimize the tax. But if your IRA, or say for example you buy into syndication, and that syndication is taking leverage, they'll pass that UDFI tax on through to your IRA. Then you've got to pay your CPA to file one of these things called a 990T, and they're going to say, a what? Because they don't know what this is, and there are only a few CPAs I know that specialize and that will do the 990T. So just know that there's this tax when the IRA borrows money. The other tax is called UBIT, Unrelated Business Income Tax. Anybody in here a flipper?
Yeah,
Fixing, flipping,
that's
right?
What I was thinking of right
Yeah.
now. That's how I know they tax.
So the IRS, which, of course we love them, and they have all these rules, and most of them they don't even write down. Am I right, Matt? Who's a CPA?
Yeah, it's amazing.
Right? So here's one of those rules. If you're going to flip properties, you can do pretty much 3 a year in your IRA, but after that they're going to say you're running a business in your IRA. So that is not written down anywhere.
3 a year?
3.
Is safe?
3. It seems to be what we've seen in practice to be the rule of thumb. But here's the good news. There is no limit to how many IRAs you can open. Okay? So you just open another IRA. You have to pay your fee again, but oh well, you get to have 3 more houses. The only limit is contribution, how much you can put in. So say, for example, you've got traditional and Roth IRAs, maybe you've got 10. You can have as many as you want, but you can only put, if you're under 50, 5 grand, if you're over 50, 6 grand, that much per year in all the accounts combined, traditional and Roth together. Right? That's your limit. Isn't that weird? These rules, like I would think it would be per account. No, it's all of them combined. And they're even talking about lowering that back down to $2,000. That's something that's, yeah, I know. So make it harder on people. It's crazy. But these taxes, you can read about them at irs.gov. It's publication 598 that talks about these taxes. So rather than give you tax advice, you can look it up. And I have a story, but I'm not spare you, so it's a good one. So when you buy real estate, we all know how we get like shares of Apple in our IRA, right? You pick up the phone, hey, I want 100 shares of Apple, thanks, done. As long as you have the cash to cover it, the shares are in your IRA. That's great. Well, if you want to get real estate in your IRA, it's a little bit different process. First, like I say, please open the IRA and fund it first, so the money's in there, and then go shop for your property. Because if the money's in there, then you can buy an asset, right? So once it's open, and then you've got to make sure that you remember that the IRA is the buyer, the custodian signs the offer to purchase, not you. And this is how you do it. You give us what we call a bi-direction letter. It's our form. It's basically a permission slip to send your money out. One-page form. A bi-direction letter with the supporting documentation, and that's the PPM, that in the subscription agreement, or maybe it's the offer to purchase, or whatever it may be. Maybe it's the note, whatever you're investing in. So the direction letter and the supporting documentation, 24, 48 hours later, we get the money out into your deal. Now your IRA owns that asset, and all the proceeds from that asset go back into the IRA, tax-free or tax-deferred. Okay? So now you understand the process. You open the account, fund it, and invest. Now here, just like a cash deal, we're going to wire, or even like a mortgage, the funds are going to be wired to closing. You fund, you record, you get your keys, your tenants move in. Now there are a few things that you can do here. The rents Number one can be made payable to the IRA. Custodian, for the benefit of, like Linda Pliaga's IRA, for example. Well, someone was here earlier and said, that's long, you know. I can't type that on a form. There aren't that many characters in the field. You're right, it's long. And so what I say is get your tenants a rubber stamp so that they can just stamp their check like that, you know, and that makes it easier. The runs can be made payable to a property manager. So a lot of the companies today are talking about property management, right? And so you write the check to the property manager then cuts the check to the IRA. Because what if 2 IRAs bought a house? Okay? Then you've got to write 2 checks. Well, you don't want to bother your tenants with that. It's not their fault that 2 IRAs are investing in the property they live in. Let them write the check to the property manager then disperses it out to the 2 owners like that. And that's really handy. Now the third way, we'll get to that in just a second. And I'm not going to do this. By the way, if anybody has a happier father and son, send me a picture. Yes.
On the length of that you were talking about, you could actually use their account number rather than their name, so that shortens it up a little bit.
No, you can't. I tried that.
Really?
Yeah.
Equity Trust has been accepting mine. I hope I'm not going to get the IRS knocking at my door.
It's a custodial preference. So.
Okay.
Yeah.
Oh, it's a custodial
yeah.
preference.
So
okay.
We prefer your name.
Okay. Gotcha.
So, all right. Real estate. This will shock you. Real estate has expenses. Are you surprised? Have you ever bought a house that didn't need something? I mean, they don't exist. A new construction house. You still have to put in landscaping. You still have to put in mini blinds, right? There's no house that doesn't have expenses. Forget those kinds of expenses like the hardware. What about property taxes? What about, you know, sewer bills and things like that? There are always expenses with real estate. And your IRA has to pay all the expenses of your asset. So what do you do if your IRA runs out of money? You never know. That tax bill. Remember supplemental tax, when the values were going up, we get the supplemental tax bill, and so many people were caught unaware by that, like, what? I owe what? Well, if your IRA owes that and you don't have the money, what do? You call me if you forget, but there are 6 things. Number 1, you write a check and make a contribution to your IRA. That's usually people's first line of defense. Number 2 is your IRA may have a house, but it also may have some, say, gold bullion over here. So you sell that gold bullion, take that cash, and use that, say, to pay your tax bill, and that'll be fine. Now, maybe that's not going to work for you, so maybe you have an IRA somewhere else. Maybe you have your self-directed IRA, but you left some money over here in, you know, Vanguard, Charles Schwab, TD Ameritrade, something like that, because you want to stay in the stock market. That's great. So you liquidate some of that and send it over. Use that. Usually that's what people are going to do, but if none of that works, you can take on a partner. So long as they're not disqualified, you know, give them a share and they give you some cash and you write up an agreement. You can do that all day long. You could also get a loan, but in this case it wouldn't be an institutional loan, it would be from an individual. Have them give you your IRA a non-recourse loan. And if none of this works, you can just sell the asset. If you say, hey, too many expenses, I can't get out of this, if you can, you could sell the asset. And that's what you do if the IRA depletes its reserves. All right, so here's, you know, remember we were talking about how the tenant making their check payable, how can they do it? And I told you that they can write it to the IRA, they can write it to the property management company. Well, here's a third way. It's called the checkbook IRA. Matt alluded to it earlier. And I was in Atlanta and I took a 2-day class on this, so it was 16 hours of like drinking from a fire hose because these 2 attorneys and a CPA were just telling us so much information. I thought it was in law school about how to do this. So you ready for 16 hours of information in 2 minutes?
Yeah.
You want to hear this? All right. So the IRA is open and funded. The self-directed IRA is open, money there. An attorney draws a special purpose LLC. This is not LegalZoom. This is not prepaid legal. This is a special document. Must have special language in it. The IRA funds the LLC's checking account. Because you've got this LLC, it has a checking account, you're the managing member, money goes from the IRA to the LLC's checking account, you're the managing member, now you have checkbook control. Okay, so then you say your IRA already owns the house, you can transfer that IRA-owned asset into this IRA-owned LLC, all right? So now the LLC owns the house. Your tenants can make their check payable to the LLC. All right, so we're going to do this again. And I'm just going to do it right here. Because, and by the way, 2 things. I give a free class on this in Orange County every month, and also I have a link to that class. We recorded the class. If you want the class link, I will email it to you. Just request it, and I'll give you my email at the end, all right? But here, so you've got your IRA here, right? And this is like the mothership right there. And so here, what it's going to do is it's going to buy this special purpose LLC. So the checkbook IRA is an IRA-owned LLC. Now this LLC is going to purchase assets. And that may be, your house. So, this house is owned by the LLC that's owned by the IRA. This is an IRA-owned asset. Okay? And it flows to this. If this is a single-member LLC, it's basically a disregarded entity. You're not filing a tax return on this if it's a single-member LLC. It's a pass-through entity. But guess what? With great responsibility, or with great freedom comes great responsibility. If you have this checkbook IRA and you're buying houses and assets with it, you're not coming to me and saying, hey, Karin, review my deal before I invest in it to see if it's prohibited. So, that's a big deal. You want to make sure that you're not committing prohibited transactions, and you can always call and ask. You can call the attorney who set up your LLC and ask them, look, I'm looking to do, this is the deal, and can I do this deal? Is it a prohibited transaction? And then the attorney will call me and ask me. May as well just call me. But it's important that if you're going to bypass the custodial, administrator part of it with an LLC, you just make sure that you're doing it right. Okay? So it's an IRA-owned asset. So I know it kind of creates more questions than it answers, but that's the checkbook IRA right there. All right, so these are the plans that you can self-direct. These are the IRAs, right? I should add inherited IRA. If somebody passes away, then you get their IRA, then you can use it as your own and invest. These plans, these qualified plans have employees. This would be with like an employer with W-2 employees. We don't offer these 3 plans. We're not self-directing those 3 plans. But we are doing the individual K, and it's worth mentioning. How many people here are self-employed? Wow, okay. If you're self-employed and you have no W-2 employees, you could get an individual K. And let me tell you why you want one. There are 4 reasons, okay? The individual K, number 1, has a higher contribution limit. These you can put, remember, 5,000 or 6,000. This one, and this one actually, you can put 25% of your income or $49,000, whichever's less. Higher contribution limit, that's one thing. But the individual K is special. Instead of a retirement age of 59.5 that they all have, this is 55. So that's cool. So you can take your money out of the individual K without paying penalty. You just have to pay the income tax at 55. The third thing is that you can take a loan from this. And that's really interesting. I've got a lot of people who've lost their jobs, and they'll open an individual K with their old 401k money and take a loan from it, and that's fine as long as you make a contribution in the future. The IRA, because if you just open an individual K solely for the purpose of taking a loan and you never make a contribution, it could be a prohibited transaction. It could be present benefit. But you can borrow money from this. That's really cool. But the fourth thing is really, really interesting. If you have a Roth IRA, the money goes in, you already paid tax on it. It grows tax-free. It comes out tax-free for life. Beautiful thing. If you make more than $100,000, which a lot of people in California do, you can't put any money in that. It doesn't matter. You don't qualify to put money into it. In the individual K, you can choose to have what's called a Roth bucket. The individual K, you're the employer and the employee like this. The employer portion is up here, but the employee portion, you can put next year it'll be $17,000. It's $16,500 right now, into a Roth bucket in this individual K, regardless of your income. Okay, let's just compare. If you're under 50, $5,000, $17,000.
Wow.
Income cap, no income cap. So do you see how powerful that solo K is? If you're self-employed, no W-2 employees. Oh, and I forgot the best thing of all. We talked about the UDFI tax. If you borrow money, if your IRA borrows money, you have to pay tax. Not if you have an individual K. It's not subject to that tax. It's subject to the UBIT tax, the business, not subject to the UDFI tax. So, lots and lots of good things about a solo K. Really awesome plan to consider. And you can self-direct it, and people just love it to pieces. Okay? Again, I've talked to you about the 3-step process, but I'll mention this again. You open the account, our form, you go online. It's form fillable. You type on the first page, it autofills the rest of the 24-page document. So when you see 24 pages, you don't have to have a cardiac arrest, or say, oh, I'll put it off till later because it's 24 pages. You just fill out the first page, your name, your social, who's your beneficiary, and where's your money at now. And then it fills in the document. We need about 6 pages of that back. Along with your driver's license, there's a $50 setup fee and a